Keith, are you
Yes,
there?
sir. How are you, Tom?
Very good. I am well. Thank you, my friend. Thank you for jumping on my podcast. Keith Burgess is an insurance guy. And I
That's
met
right.
Keith a few weeks ago through, it was a referral from my estate planning attorney, where I'm getting my estate plan updated. And I needed more insurance. And my estate planner, Dan Rutenberg, great estate planner, by the way, great lawyer here in Virginia, Northern Virginia, recommended his pal Keith Burgess, who I think you guys play poker together and you like do stuff together and you're buds. But either way, that's how the world works. So thank you very much for coming on the program, Keith.
Thank you for having me, Tom. I appreciate that. I have been in the insurance business since I got out of college. So,
So tell me about that. So tell me about your how you chose to get in the insurance business and what it's like.
um, how I got in initially, I was a wrestler in college. I went to the University of Maryland. I was a wrestler in
You
college.
look like a wrestler.
I,
He's got some big biceps, gang. If you haven't seen him, he's
I
got
do
some big. There you go. Sorry. Go
not,
ahead.
not as big as they used to be, but that's okay. So I wrestled in Maryland, and there was a guy named Alan Meltzer who used to come into our wrestling room, and he was I think he was 42 at the time, so it was impressive. He would still go into a Division I college wrestling room and compete with some of my guys on the team. But I met him. He was in the insurance business. He had a small company called the Meltzer Group, and when I got out of college, I went to work for him. So I've never really known any other real profession. So it's been great. I mean, the insurance business, just like any other business, it's hard work and building relationships and just kind of staying knowledgeable in my field and working hard. So been doing it a long time.
Speaking of knowledge, that's what I said. I said, I wanted to do this podcast with you because, I'm a big dummy when it comes to insurance. I'm 55 years old. I've got insurance, but I don't have enough insurance. And that's really the thing is that as you grow and you get more stuff and you have more babies and grandbabies and businesses and acquire more things, you got to protect that stuff. And that's what insurance is all about. And so when I was doing my trust, I was talking to Dan. He's like, "You need more insurance, man." And I'm like, "You're right." And so he introduced me to you. So let's talk about insurance. So there's different kinds of insurance. So could you explain to me and to everybody what the different types of insurance there are?
Sure. And I assume you're specifically talking about life insurance because that's
Yeah, life insurance. Yeah, we're not talking about car insurance and all that stuff. Here, folks, we're talking about life insurance to protect yourself, your assets, and your family.
yes, yeah. So I mean, life insurance. Funny stories. When I first got in the insurance business, I would make a lot of phone calls each day, and me and a couple other guys that were making phone calls, we'd come up with how many ways we could use the word life insurance without saying life insurance. Key man insurance and
Right.
executive compensate, all these different words. But yeah, there's many uses of life insurance, and it depends on the use. What type of insurance you should put in place, and it depends on the person that's getting the insurance. You specifically needed life insurance, to kind of to insure your estate, to insure the assets that you're planning on passing on to your family. Most people buy life. Statistics show that people buy life insurance about 7 times over a lifetime, which I think is, if it's done properly, you don't need to do it as many times. But then there's people that have businesses like yourself, so you may need key man life insurance, key person life insurance, which I think you were advised that potentially for your business you may need some life insurance within your company. People buy it for personal reasons, and that's the main reason people buy it. Is one of the best insurance people that I've ever worked for, Alan Meltzer, told me, people buy life insurance because they love their family at the end of the day. So that's the purpose and the reason to buy life insurance is, if you care about your family, you want to make sure you don't leave a mess. If you die unexpectedly, then you buy life insurance. And so back to your question is the types of life insurance. there's basically two types. There's something called term insurance, which is good for a period of time. Like the word term, it's good for a term. It's good for 10 years, 15 years, 20 years. There's even 30-year, what's called level term life insurance, which is guaranteed for the period of time you buy it for. So it's very inexpensive. I was talking to a young man this morning who's 32. He had his first child. He was told to talk to me about buying life insurance, and it's very inexpensive. It's
good for him.
Yeah, and it's something that everybody should do. And most people, USA Today had an article many years ago about 79% of the population is grossly underinsured for life insurance, and I think it's something that should never happen, because it's a pretty inexpensive product at a young age when you're healthy to put some in place. If you buy an inexpensive term policy, it's very inexpensive. It's probably less than buying a cup of coffee at Starbucks every couple times a week. So it's
right.
It's a prudent thing to put some in place. But term insurance, again, it's very inexpensive, and it's good for a period of time. So even for myself as an example, I bought some term insurance that was 20-year term and 30-year term, because I wanted to ladder the coverage. So when when one of my kids get out of college, it goes down. Hopefully I'll have some assets built up. I won't need as much over certain periods in your life. But the other type is called permanent insurance, and there's actually many different types of permanent insurance. There's something called universal life. The oldest form of life insurance that's been around for a couple hundred years is called whole life, and it's a more expensive product, but it very conservatively builds cash value through dividends. So the insurance company pays dividends, or if it's a stock company, you participate back in return of the company. So it's a conservative way to build cash value, and over a long period of time, you may end up getting 3 to 4% in the policy. In the last 10 to 15, 20 years, they've developed a product called variable life insurance, which people like to invest in the market. They like to invest in equities and mutual funds in the market. So they developed a product called variable life, which kind of mimics that of investing in the market, where they have these side accounts, and your cash value will go into these side accounts, so you can actually have the ability to do better with your cash value under the umbrella of a life insurance policy. And the benefits of having a cash value life insurance is the tax deferred growth you get in a life insurance policy. So, I wouldn't use it to replace an investment, but it's a good supplement to a retirement plan, or it's a good, if you're going to buy life insurance and you're going to own it for a long period of time, or if it's a permanent need, I'll give you a good example. Key person life insurance within a business. That's a short-term need. In short-term, as you know, businesses move around and change, and buy and sell very quickly in today's marketplace. So normally, when I sell term life insurance for a key person policy, it's a 10-year term, because a lot's going to happen in your business in the next 10 years. The value could go up significantly, which means you can need more life insurance. You could sell the business. So it's an inexpensive product, but it insures your key people, or the patriot of the company, for a period of time when it's most needed. Back to personal insurance, I usually explain to people the differences between term and cash value life insurance. And people, after you explain it, they really like the idea of permanent insurance, because it's going to be there for the rest of your life. It's called permanent because it'll pass on to your heirs no matter when you die. And it builds cash, depending on the type, it builds cash value along the way. So it can serve two purposes. You could use the cash value during your lifetime. It's not an IRS qualified product, so there's no limitations on when you could take the cash out, even though it's tax deferred growth. And there's different ramifications on what happens to the cash value from a tax standpoint, depending on if you keep the policy in force or not. But we don't have to get into that detail. But permanent insurance is a product that it'll always be there. You pass it on to your family, so it can be an asset on your balance sheet. The cash values are an asset on your balance sheet. So that's
permanent whole life insurance.
That's permanent whole life. It could be universal life. It could be
term insurance is not an asset. That's right.
Correct.
That's so. Let me ask you this: if for a guy like me, and the people that are listening to this are many lawyers and doctors out there, entrepreneurs. They own their own business. So I'm 55 years old, and you and I have talked, so I'm fine with sharing this information. What do you recommend for a guy like me for my business, or for I have 5 kids. I have three grandchildren, 2 grandchildren, one on the way. So, and more coming, I'm sure. But what do you recommend? Not term, right? I shouldn't get term. I should get whole life. What do you recommend?
Not necessarily, and it really comes down to, it's funny because you read these articles in different financial magazines and they recommend whether you should have term insurance or permanent insurance, but they're looking at it with a broad brush because you as an individual, you have very specific needs and very specific wants. I mean, it's what do you want to accomplish? You have 5 kids and grandkids. You may want to have that insurance in place for the rest of your life just because you want to make sure you pass on a certain amount of assets. So, I mean, let me step back for a minute and give you a good example. We'll go back to the younger person I was talking to. A younger person may not have any assets, but they may have a good income. So the real purpose of life insurance at the end of the day is a replacement of income tool. So,
Right.
life insurance is, I'll give you a good example. An attorney in DC that's 35 years old is making $500,000 a year, but he doesn't have a lot of assets, and he has a couple kids. Well, he has a really big need for a replacement of income for his family because if his wife, let's say his wife is not working, or if she's working and she doesn't make as much money, whichever person in the family is making the most money, that's the person that needs the biggest replacement of income. So they say that, you can live on, whether you want to live on it, but let's say that your family can live on 70 to 75% of the income that you made if you were to pass away. So if you wanted to replace that income to your family for either forever, for the next 20 years, adjusted for inflation, it's easy to use a formula to figure out how much life insurance that person would need to replace a portion of their income for the next 20 years. So their kids are grown up, and their wife potentially could have been remarried. But the point is that it's truly, for a young person, it's truly a replacement of income tool that you want to make sure if you love your family, you want to replace your income to your family, not leave them kind of stranded, then you would load up on some term life insurance. And if you have the income and the cash flow, you might want to buy a small amount of permanent insurance as well. But I usually use a combination of term insurance and permanent insurance for somebody that doesn't have, a lot of money to spend monthly. You're in a different situation. I think you said you're 55. You have a successful company. You make a good income. You may already have assets built up. So I take that into consideration as well. As like, let's look at your assets. You may have a large 401k plan. You may have some real estate that has a lot of equity. You may have a business interest that has some value. So we could quickly figure out the need for life insurance, and your need again may be different because you may have an estate that may have some estate tax issues if you were to die. As you know, with estate planning, when you talk to your estate planning attorney, Dan, all your assets pass to your wife without any taxes due at the first death if things are set up properly. It's the second death when estate taxes are due. So if you have an estate tax issue, that's a different need. You would need permanent life insurance, and you want to put that into a trust outside of your estate. And so that need for life insurance is very different because when that policy cashes in, that money is used by your trustee or by your kids to pay off the estate taxes that are due to the government. And so all of your assets pass on. I mean, I'll give you a good example is, I'm sure you know who.
So that's interesting. So that's to protect the kids.
Yes.
Right?
Yes.
Got it. Go ahead. I'm sorry to interrupt you.
Or whoever you're passing your estate on to.
Right.
But I'll give you a good example. In most people,
as long as they're good.
That's right.
As long as they're good.
Yeah, and I've been in the business long enough where I met with plenty of wealthy people that had no interest in buying insurance to pay the estate taxes because they really didn't care what happened to the money after they died. So that's a tough person to talk to about life insurance.
That's tough.
Yeah. But most people are aware of Joe Robbie. Joe Robbie Stadium was the family that owned the Miami Dolphins when they were in Miami. He died without an estate plan. He died without a will, without an estate plan. and no insurance. So the value of his estate, which was very large, was the majority of his estate was made up with the value of the dolphins. So when he died, and the government said you owed a huge amount of estate taxes, he didn't have the money or the proper estate planning to pay those estate taxes. So he had to sell. His family had to sell the dolphins to pay his estate taxes. So that's what you don't want to happen, is you have to sell assets at a fire sale to pay the estate taxes. Then your estate is reduced significantly. But yeah, so I'm sorry, I didn't mean to interrupt your last question.
No, it's okay. And I had some my computer blipped out. It's the whole Zoom world. I don't know. My dog is also under here messing with the wire, so who knows what happened. Anyway, that's great stuff. So tell me, what are some of the biggest mistakes that you have witnessed in your life as an insurance broker that people have made?
Well, there's many. I'll start with some simple mistakes. Is number one, just not buying enough life insurance. Is a simple rule, especially if you're in your younger working years, is you should probably have about 8 to 10 times your income in life insurance. So if I made $100,000 a year, I would need $1 million of life insurance, and it's easy to figure that out by just dividing your income by a certain interest factor, a very conservative interest factor, to find how much life insurance you would need, and then you could figure out the annual income you could pull from that. But so one of the biggest mistakes is in your situation is if it's not set up properly, is putting the beneficiary down incorrectly. If you have the wrong beneficiary, if let's say in this area, as you know, there's the divorce rate is 50 or 60%. A lot of people have life insurance policies where their wife is the beneficiary, and then they get a divorce and they just forget to change any of the beneficiary information.
Oh, yeah.
Or
Actually,
even,
I have a friend that's going through that right now, who's their uncle. I think their uncle passed away, and the money was supposed to go to them, but it went to the sister because he didn't update it. Yeah, I mean, like, you got to stay on top of this, folks. You got to stay on top of your estate. I'm guilty of this myself. I mean, it took me 13 years to update my estate with Dan. And a lot has changed in 13 years. I mean, like, now thank goodness I'm on a yearly review to make sure everything is good, which is what you should do. But yeah, that's a great point. Like, oops,
yeah.
that's not good if you remarry and then and then you go and then all the money goes to your ex-wife that you hate, or ex-husband, whatever.
So another good example is when you buy life insurance, especially when you buy term life insurance, because candidly, it's a less expensive product. So if you look at how many policies are sold, probably 80%, 90% of the policies that are sold in the marketplace are term life insurance because it's less expensive. There's more uses for term insurance. And one really important thing with term insurance is to make sure there's a convertibility feature. So you want to buy two things. Number one, when you look at a life insurance policy, you want to make sure it's backed by a good financial institution. A good life insurance company should always ask to see the financials. There's rating companies out there. There's Moody's, Standard and Poor. There's a lot of rating companies that will look at the financials of a life insurance company, and they give you a kind of an independent study of what they think of the long-term outlook of the company is. So you want to make sure you have a strong financial institution. You want to make sure it's going to be around. God forbid you die 20 years from now. You want to make sure the company is going to be around.
Right.
Most of the time what happens if a company goes belly up, all those policies get taken over in a block transfer by another insurance company, and there's a state guarantee corporation in every state. But back to reason to have your a convertibility feature in the policy is, you're 55 today. Let's say you bought a 20-year term policy, which takes you to 75. But in three years, God forbid, the doctor says you've developed a condition where you can't get insurance anymore. So I mean, people, I'm 52, so people always think they're going to get healthier, but that's usually not the case. People,
Right.
you don't usually get healthier. So as you develop health conditions as you get older, you become less insurable. So, some people will say, well, I'll just buy this 10-year term or this 15-year term insurance because it's inexpensive. And then, I'll buy another one in 10 or 15 years. Well, you may not be as insurable. You may actually be uninsured.
Exactly.
So having a convertibility feature within the policy, in the term policy, is an important thing. So you can convert, and what that means is you can convert over to a permanent policy within the same life insurance company you were approved with at the same approval rate, meaning let's say you got approved at a preferred non-tobacco rate. You can convert the policy to one of their permanent policies at the same preferred non-tobacco rate. So it's going to be more expensive.
Let's talk about, go ahead.
I'm saying it's going to be more expensive because you're converting it to a permanent policy, but at least you have that ability to do that. And, if you look at the internal, return on the policy, based on when you actually are going to die, it would make a lot of sense to convert it at that point.
Let's talk about long-term care.
Sure.
Because we talked about that when you and I were discussing. So let's tell people what is long-term care? What is long-term care insurance?
So in simple terms, long-term care insurance is insurance when either the individual or their children or whoever's their caretaker, candidly can't take care of that person anymore, whether it's in a home, whether it's in assisted living, or you have to move to a facility. It's as you get old, you might not be able to do what's called the activities of daily living. And that's, long-term care insurance policy. The definition says if you can't do 2 of the 7 activities of daily living, and that includes, walking, dressing yourself, continence, using the toilet, feeding yourself, and just the basic activities of daily living. If you can't perform those activities of daily living on your own anymore, and your doctor, a certified doctor, says you need help, and you need somebody to come to the house for an hour a day or all day, depending how bad it is, or if they need to move you to a facility, those can be very expensive depending on where you live. And as you know, more and more people are turning 65 every day. People are living longer and longer. Medicine is better, so the need for long-term care insurance has become a huge. It's a very hot product. And what it does is it pays for those expenses. So there's limitations on the policy, but it helps pay for those expenses. If you have to go to a facility that costs $20,000 a month because you can't take care of your own mom or your own dad, and they have to go to a facility, it could be very expensive. So that's what that insurance would cover.
Yeah, I got a buddy that his entire savings was spent. Everything he had saved up, he had spent on his taking care of his mother-in-law. They took care of her in their home and ate up all of their savings. But this is what long-term, or that's what insurance is for. It's Correct. Not for when you're dead, and you get paid. This is for paying for when you just can't take care of yourself anymore. Otherwise, you got to pay for this. And you don't want to be stuck in a room somewhere, You want to be taken care of very well.
That's right.
At least I do. I hope everybody else does.
Oh, you're 100% right. They say that, in most cases, people would rather age in their home than have to be made to go to a facility. They'd rather. Yeah,
but you can set up your home to be like a hospital these days, and have somebody come and take care of you and stuff.
That's right.
But that's very expensive. What did you tell me? It was like $500. How much was it a day? Like you told me?
Well, there's online. You could find out what it costs in average in a certain zip code, what it costs per day to have that type of care. It could be $150 a day up to $500 a day, depending on where you're located.
Yeah.
So it can be very expensive. But back to what you were saying is, the government will not let you can't make a claim to Medicare, for example, until you spend your assets down. So you could spend your lifetime building up your assets through retirement, through a retirement plan, just saving money, and you could have $500,000 saved up when you retire. That could go away in a matter of a couple of years if you had to go into a home or get that type of care in your home. So and that's you have to spend that.
You made a great point earlier. Both of us were in our 50s, and we're both in good shape and stuff, and we think we're going to get better. We're going to get that, that beach body that we were in our 20s. We're going to get there again, but that ain't really going to happen. It's just going to get worse.
Right.
And so, people got to snap too and pay attention to this stuff and protect yourself. Protect yourself and your family with life insurance, whether it's term. Like, you're right. I think if you're young, you get yourself some term insurance. That's good. But as you get older, to my age, you got more assets, more family obligations, people to take care of, people that are depending on you. And you got to get whole life insurance. You got to switch it to that. And then long-term care. And don't forget about that stuff. You got to have that in case, you become feeble and you can't move around and stuff like that. You don't want to get sent off. And well, even if you get sent off, make sure you get sent off to a paradise for the remaining years, right? So
right.
I think isn't that it? That's the three main types of insurance that we're talking about here, right, Keith?
Term insurance, permanent insurance. You say whole life. That's a form of permanent insurance, but
yep.
And then long-term care.
Long-term care.
And if I could add, one thing we spoke about is sometimes, long-term care is not inexpensive. It started out as a pretty inexpensive product many, many years ago. I sold my parents long-term care insurance, and their premium is gone up 400 or 500% since I sold it to them. So, and I think what had happened, and a lot of life insurance companies have got out of that market. There's only a limited number of carriers that even sell it anymore. And what happened is, the actuarials really underestimated, that people would be not only using the policies, making claims on the policies, but actually holding on to those policies. So they're not getting rid of them because they see the value in them. So, a lot of insurance companies took a bath on those policies. They either got out of the business or they continue to raise the rates. So, back to my example is, a policy for somebody, husband, wife in their 50s, it could be $5,000 to $10,000 a year. It's not an inexpensive product. So what you and I spoke about is, now life insurance companies have added a rider to the life insurance policies, the permanent policy. They've added a rider. If you wanted to get a long-term care rider on your policy, what that allows you to do is that allows you to spend down your death benefit to use it for long-term care needs while you're living. And then, so candidly, what happens is it kind of builds up a loan against the policy using some of those proceeds of the life insurance policy to pay for long-term care needs. And then at death, it's repaid out of the tax-free death benefit. So if you had $1 million and you used $100,000 for long-term care needs, the tax-free death benefit would still pass on to your heirs, but it would be $900,000 to that point. So and people like that option because it's a pretty inexpensive rider that you can get on your insurance policy.
Yeah.
So,
and I think that's what we're doing, right? That's what we're doing for me. Yeah. Very good. Well, Keith, this was great. Thank you very much for explaining all that to everybody and to me again. Like, you and I have met a couple of times and you've explained it to me, but I think I really got it this time. I really understand it this time.
Yeah.
So how does somebody that is interested in getting insured in any of these ways, how do they get in touch with you to get this happening?
Yeah, so I work out of the NFP office in Bethesda, Maryland. It's Keith.Burgess at nfp.com. I can give you my phone number as well. People can call me direct at 240-793-4423. Happy to have a conversation. And like I said, everybody's situation is different. A lot of times very different. So it's really comes down to just the conversation of what that person would want to accomplish. And then I can help them determine the type of coverage.
Fantastic. Keith, thank you so much for joining the world of marketing. Even though we didn't even talk about marketing, but this is important stuff. This is about insurance that everybody should have. And you got to get it that's right for you. Everybody's a unicorn when it comes to this. So if you don't have insurance or if you're thinking about it, please call Keith, my friend. He's a great guy to talk to, really easy to talk to. He's not going to push it on you. He's going to find something that's right for you. Thank you so much, Keith, for joining my podcast. Everybody, if you liked what you saw today or heard today, hit the like button, ding, and subscribe to the World of Marketing. Keith Burgess, thank you so much.
Thank you for having me, Tom. Much appreciated.
All right, buddy. Everybody, I'm out. Tom Foster in the World of Marketing. See you next time.